These days, laymen and academics alike are all pointing to um, the idea that the market is really at very high valuations, that stocks are very expensive. This is actually, very true. Stocks right now are very, very expensive. If you're judging them on, a price to earnings ratio, and they're just dangerous to buy right now. It's very hard to choose where you're going to buy. So how do you know what stocks you can get in 2017? In 2017, a very popular method in over the last 5 years for investors to make money was indexing. You just put your money in the S&P 500 and you make money, and that worked all the way up to 2014. But after 2014, we had such a big run up between 2009 and 2014 that in 2015 the market really saw nothing. In the beginning, throughout most of 2016, the market also really was underperforming and not doing much. It wasn't until the Trump election happened that we saw a lot of volatility, and the volatility is really a result of unknowns and people just guessing about who's going to make money and who's not. So what's a good way to value a stock, and how do you know what to buy in 2017? My advice is to go for the value plays. Go for value stocks that companies that have been around for a very long time, that recovered quickly from the crash in 2008, and companies that are at the lower end of their historic PE ratio. So some companies usually trade between, let's say, 10 and 20 PE. You want to buy them at the price that's when they're at their lower range of the PE. So if they're 12 or 13, that's good. But once they get up to like 15, 16, you don't want that, because there's a good chance these PE ratios could drop over time, especially now that we have priced in a lot of what's going on with Trump. So if he's going to reduce taxes and he's going to reduce regulations, profits are going to go up for a lot of people. A lot of companies are going to increase profits, but that doesn't mean their stock price is going to go up. Their earnings will go up, but their stocks may trade at what they are now, or maybe even lower, just because we're going to see the PE ratios come down. Is a crash imminent? I don't think so. I think we may have slight pullbacks, 500 points here, 300 points there on the Dow, but I don't think we're going to have a big crash of 2,000 points or more, like anything close to anywhere near 10%, simply because, with Trump, regardless of what you think about his policies, the biggest corporations that make up this S&P 500, they're all going to mostly benefit. You're talking about a big cut to corporate tax, which some of these companies pay, but you're also talking about a big cut to regulation, financial regulation, and all different types of regulation that really stifle the ability for these companies to grow, because they're always stuck doing paperwork and answering subpoenas and doing things like that to be able to actually focus on their business and getting out the best products and services that are available. And with these big cuts, it's going to come a more even playing field, where the smaller businesses and the small and mid caps in the market are going to have the chance to gain market share. Regardless of what you believe, that's probably going to be the fact. So that's where a lot of the growth can come from. So you want to look for these value plays and some of these income plays, just in case there is a downturn in the market. You want those high dividend stocks that in the time period that till they will recover, the stocks that are paying the higher that are paying you the dividends, so that you'll have that 3%, 4% a year coming in, regardless of what the price of the stock does. So those companies that have consistently increased their dividends for 10 years, 15 years, 20 years, 25 years, those are the companies that you want to own through this. In 2017, you really want to look for things that are undervalued, because you can't just go out and buy an index. You'll get burnt like that on the next correction. You could either keep your cash on the sidelines, which a lot of people are doing, waiting for a correction, because in truth, the correction is long overdue. there's just it's just the market has had such a big run up without a recession from 2009 that we're due for one, and because of the way that the economy is structured now, that there's so many long-term unemployed and people that just don't work, that have given up looking for work. There's so many of those people out there now that are permanently unemployed or permanently long-term unemployed, that you can't really bet that we're going to have economic growth that could keep fueling this bubble. We're in a correction period, and so we got back up and even higher than where we were before 2008 in many respects. But the underlying fundamentals of the economy, of the structure of the economy, and the way that the distributions of capital are, diversified in society to be able to spur things like consumer spending, are not existent. All we really have is money going to people who have owned the assets that have seen massive asset inflation, like stocks over the last 7-8 years. But bonds, like we're seeing, bonds have been giving horrible yields for the last 7 to 10 years, and bonds are the basic a real competitor to stocks, if you will, in the financial market. Those are usually the two that people choose between when deciding where to invest. Should I invest in bonds that are going to give me back a more steady, more more consistent return, that either monthly or quarterly, that I'll get that check in my pocket every month, my investment will pay off right away? Or do I try to get more gains and put the money in stocks and hope that that the compounding interest will grow so much to support me in the future, as opposed to me getting bond payments now and realizing the profit of my investment? So what you should do is, if you're gonna buy anything, make sure it's under that PE. But you don't just want to buy anything because it has a low PE ratio. It might have a low PE ratio for a reason. It might be because the growth prospects for that stock aren't that good. So there's utilities and there's things of that nature, bank, financial stocks. If you can find these things at a good price, they're guaranteed to produce you some kind of return, especially utilities. No matter how bad our economy gets, gas prices, that's gas for your home, not gas for your car, electric prices, those things are always going to increase with inflation. And just when you face it or not, these utility companies, they make their money every month like clockwork. People need them to survive. It's a necessity at this point, so there's very little chance that we're going to see electric companies go under anytime soon, or even take a big hit. If anything, they could become even more valuable in 2017, simply because the plays in growth are not going to be there anymore. We've seen crazy runs up in the tech sector. We've seen crazy run up in the financial sector. So a lot of these growth stocks are just not going to produce the returns that you want from them. They may even produce negative returns for you if you didn't get in, if you're not well enough diversified. So those utility plays and those big value companies, those Coca-Colas and things like that, those are the stocks you want to try to get a good price on, and if you can, pick them up in 2017. Stay away from tech. When you look at pharmaceuticals, though, pharmaceuticals have been taking a beating since Trump got elected, and throughout most of 2016, really, because Hillary and Trump, neither of them were seen as being really good to the pharmaceutical companies. But if you could pick up pharmaceutical ETFs or something like that, a well-diversified group of these biotech companies, maybe in one asset, in one ETF, then you could do it. There's a good chance that we'll have a run up in these pharmaceuticals. I think that whatever the Republicans replace Obamacare with will be beneficial to companies like United Healthcare. They're not going to leave these big corporations out in the dark, changing these regulations on them without some real serious payoffs going on in the industry. So that's something I like to. So just to review, what we actually are seeing that we like in are a lot of biotech and pharmaceutical companies to pick up for the next future. 2 to 3 years from now, they'll definitely give you a decent return. We're staying away from picking up more tech. We're staying away from picking up more finance. Those are the time for those, or those are past already, and we really need to wait for a correction in order to get value out of those stocks. We love, of course, stocks that pay high dividend, that are constantly increasing their dividend, that have mature business models. Stocks like Coca-Cola, stocks like AT&T. When you get a chance to pick those up on the dip in 2017, you do that. And you just have to research. You have to do your research. You have to look at the balance sheets. You have to look at the growth prospects for these companies. You have to look at how their stock traded in the past, and you have to look at the dividend that they pay you. There's so many things you need to look at, and that it's not as easy as set it and forget it, like you are in a recovery right after a big crash where so much is affected that the aggregate of everything goes up. We're not seeing that happen. We'll only see that happen if we have a big correction. But other than that, it's going to be, a winners and losers type of market. Some stocks will win, some stocks will lose. I don't think the indexes are going to move too much up. Maybe we'll get, if we're lucky, a 5% move. But the stocks have run up so much just after the election that almost everything is so overvalued now that it's not even something you should consider. So be careful with what you're picking and choosing in 2017. It's always safe to invest in S&P mutual funds and into ETFs that are index ETFs, not sector ETFs, but rather larger indexes like the S&P 500, because there's so many stocks in there that you have less of a chance of taking a huge dump on it than you would with any particular stocks or a portfolio composed of different stocks. You just do. You have a better chance in the long run, and in the long run means at least 5 to 10 years. It doesn't mean overnight. It doesn't mean 1 year. For 1 year to 3 years, you don't want to gamble in the market for something that's short of a time span, just because there's so much uncertainty now. It might be better. We might have, if we have guidance through 2017 that showed us that, the policies are really shaping up to be beneficial to a lot of different companies and to the economy as a whole, then go for it. But right now, we don't know how Trump is going to act as a president. There's a lot of uncertainty, and that uncertainty equates to a lot of volatility and risk in the market. So if you've been long, it's probably good to stay long and hold. That's your best bet, because you already made profits. So if you have a small correction, it's not going to do as much damage to you as if you just get in now and bet and take big heavy losses. So think about that before you buy any stocks or anything else. With interest rates going up, bonds are going to be paying more. So you could do better off bonds in the next couple of years than you have been doing in the last few years. You can really reduce your risk once the interest rate, if there really are going to be 3 or 4 interest rates hike in the year like the Federal Reserve claims there will be, although I don't think there'll be more than 1 or 2. But if the interest rates do go up, those bond payments will go up. And I'm not talking about bond funds that hold these massive amount of bonds, and then when the interest rates go up, the price of the bond drops, and your money that you lost basically negates everything that you would have made. I'm talking about actually buying bonds, because no matter what the bond is worth, while you're receiving the payment, when you cash out that bond at maturity, it's par value. You buy a bond for $100. When the bond expires, you get your $100 back. Plus you get the payments that was along with it. So it's much safer to just play it like that. So take my words, take them seriously. I don't want you to lose any money. or to gamble in the stock market in 2017. It's too risky. This is not 2012 anymore or 2011 where we're just having up and up and up and up and up and up and up. We're not going in that direction anymore. There's a good chance the market could crash from here and not recover for a long time. So take that into consideration. If you're judging them on, you know, a price to earnings ratio, and they're just dangerous to buy right now. It's very hard to choose where you're going to buy. So how do you know what stocks you can get in 2017? In 2017, you know, a very popular method over the last, you know, these days, laymen and academics alike are all pointing to the idea that the market is really at very high valuations, that stocks are very expensive. This is actually, you know, very true. Stocks right now are very, very expensive. The market also really was underperforming and not doing much. It wasn't until the Trump election happened that we saw a lot of volatility, and the volatility is really a result of unknowns and, you know, people just guessing about who's going to make money and who's not. So what's a good way to value a stock, and how do you know what to buy in 2017? My advice is, you know, to go for the value plays. Go for value stocks that companies that have been around for a very long time, that you know, recovered quickly from the crash in 2008, and companies that are at, you know, the lower end of their historic 5 years for investors to make money. It was indexing. You just put your money in the S&P 500 and you make money, and that worked all the way up to 2014. But, you know, after 2014 we had such a big run up between 2009 and 2014 that in 2015 the market really saw nothing in the beginning throughout most of 2016.